S&P 500 appears to be slightly in the reds for the day as participants eagerly await the release of the Fed's January meeting minutes later on today. In the current report, we will take a look at the aforementioned FOMC meeting minutes, while ending our report with a technical analysis of the S&P 500's daily chart. The FOMC's January meeting minutes are set to be released during today's American trading session. The minutes may offer insight into the Fed's internal deliberations when they chose to hold rates steady during their first meeting of the year last month. As a reminder, Fed Chair Powell, during his biannual testimony to Congress, he stated that the U.S. employment market remains tight and inflation, despite still being above the bank's 2% target, has slowed down. Since Fed Chair Powell's testimony, we received the U.S. CPI rates for January, which showcase an expected acceleration of inflationary pressures, with the headline CPI rate on a year-on-year level coming at 3.0% versus the expected and prior rate of 2.9%. The hotter-than-expected CPI inflation print may imply that the Fed could prolong their rate-cutting cycle, as it was implied by Fed Governor Bowman, who stated yesterday that this inflation may take longer than we would hope. However, we must state that during the Fed's meeting, the CPI rates were not yet released. Thus, with the Fed having remained on hold, we would not be surprised to see the minutes showcasing concern among policymakers regarding the possibility of sticky inflationary pressures in the U.S. economy. Hence, should the Fed minutes showcase a willingness by the Fed to remain on hold for a prolonged period of time, it may be perceived as hawkish in nature, which could in turn aid the dollar. On the other hand, should the minutes showcase a willingness by the Fed to resume their rate-cutting approach, it may be perceived as dovish, which could then weigh on the dollar. The S&P 500 appears to be moving in an upwards fashion to new all-time highs. We opt for a bullish outlook for the index, and supporting our case is the RSI indicator below our chart, which currently registers a figure near 60, implying a bullish market sentiment, in addition to the upwards moving trend line, which was incepted on the 13th of January. For our bullish outlook to continue, we would require a break above the 6,250 possible resistance level, with the next possible target for the bulls being the 6,400 resistance line. On the other hand, for a bearish outlook, we would require a clear break below the 6,100 support level, with the next possible target for the bears being the 5,930 support base. Lastly, for a sideways bias, we would require the index to remain confined between the 6,100 support level and the possible 6,250 resistance level. Those were the top financial stories for this hour. From all of us here at IronFX, we wish you a solid